the lending rules are changing for second home and investment properties. In this video, we are going to be interviewing a local lender to go over those changes and see how that affects you. You're not going to want to miss it, so stick around. All right, welcome back to the Arizona Real Estate Talk. I am your host, Michael Fabro. I'm here today with Mr. Tim Regan with Pivot Lending. Mr. Tim, please introduce yourself.
Hey, Michael, thank you for having me. Yes, my name is Tim Regan with Pivot Lending. We're located here in Scottsdale. I have been in the mortgage industry since 1999, and I'm licensed in multiple states, but Phoenix area is my home. And I love what I do. I love connecting with great folks like you and helping clients achieve homeownership. That's what it's all about.
That's awesome. Well, we appreciate you being here and spending some time to talk about some recent rule changes or recent changes with Fannie Mae and Freddie Mac in particular. So today's topic is going to be on that. We're going to be talking about second homes and investment properties and how they're being classified, is it now, or how the rates have changed for them. Maybe explain a little bit about that or what's going on.
Yeah, so there's a whole lot of opinions out there on this. My understanding is this was really kind of set into motion by the last administration, followed through with by the current administration. But essentially what it is a change in pricing to interest rates, how Fannie Mae and Freddie Mac price out interest rates, because the reason behind that is they want to limit the amount of those loans that are within their servicing pools. They want to limit that to 7% or less, right? So of the overall pool of servicing, they want to hold much more A paper for primary residence, and they want to wean off of some of the non-owner properties. So a second home vacation home, and a non-owner occupied investment property, true investment property that is generating income. Some will take this as this is a huge win for those buyers out there in the market trying to find a place to live, right? The people are looking for primary places to live. Rates will tend to be now a little bit higher for those looking for vacation and second homes, and maybe that pulls some of those people out of the market. I don't have to tell you how much demand is out there. It's huge, and it's not just here locally, it's everywhere. Okay. And so I think that is, I tend to look at things as on a bright side, right? So those families that are out there that are relocating need to upgrade and have more square footage for, increased family size and things of that nature. Those families will hopefully benefit from having just a few less buyers in that pool and competing against a few other investors who are trying to purchase investment properties. But yeah, unfortunately in our industry, it's like, oh, by the way, we're changing this. Yeah. There wasn't a whole lot of, hey, we're going to put this to a vote, or it was just like, okay, we're going to do this, right? So
that's come into effect already, correct? Like that is now in effect?
So technically it comes into effect to loans going into the servicing pool April 1st. Every lender has now instituted into their pricing guidelines so that the pricing for those programs are different than what they were 2 weeks ago, for sure.
Okay. So you mentioned a few different things in there. The first thing I kind of want to talk about is you said it only deals with the up to 7% servicing. So one, as a homeowner or home buyer out there, let's talk about as the second home buyer, I'm looking for my vacation home. How do I know that they're at that 7%, or does that even matter?
You don't. You as a home buyer, you don't, and nor should you, right? As a lender, we're here to provide a service, and so there might be a cost of doing business on the back end to those lenders and brokers and bankers who cater to that particular demographic, because it will get super expensive for them if they're delivering loans into the servicing pool. And I hate using all that, official mumbo jumbo, but essentially anybody who takes on a mortgage, for the most part, that's backed by somebody. There's very little private money. Fannie Mae and Freddie Mac are two of the main entities in the market that back mortgages, right? So
Mm-hmm.
if you're applying for a home loan, chances are that is a very viable option for you, what you would likely get to purchase a home. And so what happens is we would originate the loan. Eventually somebody would service it, and Fannie Mae or Freddie Mac kind of backs it, right? And they're really just trying to look at each individual servicer to keep their non-owner loans to 7%, and it will be different at every investor. And there will be times when they're over that. And unfortunately, once we've made the promise on the front end to a client that, hey, this is the terms that we're delivering, we have to follow through with that. And so that's why I say there could be some times here where it'll be the cost of doing business, and it could be expensive for lenders to go ahead and place that loan with a servicer. But that's really not something that buyers should concern themselves with. We're going to always, be protective of ourselves as a company, but also as consumers. We'll make sure that we're not telling them something that we can't deliver
on. Excuse me. So basically, just to put it in layman's terms, don't worry about that 7%. That literally means nothing technically for the consumer side. That rate is just going to go up. If you're looking for a second home right now, you are going to be paying more than you used to, because before it used to be set up as the same as a primary, correct?
Correct. Second homes were the exact same. And when I say 7%, I mean of the total loans, right? So 7%, not the interest rate will be 7%.
No.
But yeah. I just want to make sure I clarify that.
For
right?
sure.
So if there's a 100 loans, then 7 of those will be non-owners, right? And yes, go back to your point is second homes up until now were considered, looked at, and treated the same way as a primary residence as far as pricing and guidelines and things like that.
So aside from the interest rates going up for secondary and investment properties, were there any other guidelines changed, or was it just pricing on those two?
Yeah, I mean, it's more, the pricing is the biggest thing. So all Fannie Mae and Freddie Mac loans have what's called loan level pricing adjustments. And, we don't need to get into all that jargon, but essentially what happens on a mortgage is, on a Fannie Mae or Freddie Mac, is every 20 points of credit and every 5% of LTV results in a different adjustment for a particular interest rate, right? The higher your credit score is and the lower your equity position, meaning how much money you put down, the more you put down or the more equity you have in a property, that's where the best priced loans will be. Mm-hmm. So whenever you see advertising, which we all do, right, is they're advertising the absolute top of the FICO food chain and some of the best equity positions that are available to price, which sometimes drives me nuts as a mortgage guy, because it's not always comparing apples to apples when you get on the phone. But yeah, I mean, look, some of the arguments are, should Fannie and Freddie really be in the investment game, right? They're there to really support the primary market. People have argued that, this long time coming. Fannie and Freddie, while they're in conservatorship, really shouldn't be doing these riskier loans. So, and now they're going to be able to charge a higher premium for that, right? So they will essentially make a little bit more money for those loans. And at some point, Fannie and Freddie will have to come out of conservatorship and out of government control and be pushed back into the private market, which is how they were up until the crash. But yeah, it's never fun when those things are dropped in your lap as oh, by the way, here's what's going on.
Gotcha. So
story of my life.
So basically you're saying, I know you said a lot there. It's basically just your rate is going to be changing on those two terms. It's not so much, if I know with primary, you can do as low as 3% down. With the secondary home now, is there a minimum down payment requirement?
Yeah, I mean, second homes are still 5%. Investment properties, true investment properties. Yeah,
15 or 20.
Correct. In this market, a lot of people are looking for primary that are multi-unit, right? And those you can get in for 15% down, conventional, or if you take it government, you can do 3.5% on an FHA with, some things have to fall into place for that. But But yeah, I mean, as far as true guidelines go and required down payments, none of that changed. It's just the pricing adjustments, and they put those in place so that, one, to slow that appetite, I think, but also to make sure that there's a mechanism in place that when somebody's servicing pool goes over that, they have to be conscious of it, right? As a business owner, and I don't own this company, I work here, but I know for a fact that the owner of this company watches that stuff very, very closely. And so it's just going to be about protecting ourselves, protecting the consumers, and making sure we're putting the best foot forward and putting the right offers in front of people and right options in front of people that we can actually deliver on.
Gotcha. So does that affect, or how does that affect the primary buyer? Like, I know you mentioned someone that's looking for a primary home, where your anticipation is that because now the rates are going up for your secondary homes and your investment property buyers, some of them may pull back. And that's a good observation, because investors are always looking at their rate of return. And if your rate goes up a little bit or a certain amount, I'm not saying they're all going to go away tomorrow, but there might be those ones that were on the edge where they were figuring out these might be the numbers. They might pull back for the time being and allow more inventory. Is that kind of what you're saying?
Yeah, I mean, so look, somebody who's an active investor who's going to be out buying investment properties, this probably gives them a second to scratch their head, but I don't know if it totally puts the brakes on it. More of a road bump, and really just figuring out how that changes their margin and what their cash on cash return is over the long term, right? Real estate, at the end of the day, if you're investing in it, like anything, it's a long-term play, right? So a slight change in interest rate maybe doesn't completely take you out of the market, but maybe it makes you pause for a second, right? And maybe that's all a primary buyer needs. They put a good solid offer in front of somebody and says, hey, this is a home I'm going to live in and love it just like you did. And maybe that helps them accomplish home ownership. And so I think there'll be a little bit more of a nuance to it as it kind of settles into the market. Ultimately, there's going to continue to be a ton of demand, because I don't see prices crashing. I don't see prices having a huge haircut. You might see a flattening here in a couple of years, but I think there's going to remain a ton of demand for real estate over the next several years. So, it's like anything. We'll see.
Yeah. What do you, kind of on that topic, so what do you anticipate rates kind of going to in the next, what do you foresee in the next 12 months to 24 months? Are we still seeing a trajectory of keeping rates low? What's your take on it? I know it's, you don't have a crystal ball, but you're in the industry. I mean, you've been in this for a long time. What is your take on that? What do you think it's going to happen?
Yeah, I actually have my crystal ball. No, I'm kidding. No, I mean, listen, I try not to get into the prognostication, because I'm always wrong, or at least I feel I am, right? But, I don't think you're going to see, I don't know that we'll see rates above 5.5% or 6% really anytime soon. And that is still historically an amazing rate if you look at the long term. Now, obviously, we've been super duper spoiled for a long time. Currently rates are still in the threes. I don't see a big move. These last couple of weeks, we have started to kind of come off the bottom, right? And that's okay. Rates in the twos, you can see the unbalance it really has caused in the market in terms of what I know you're seeing. And homes going for way more than ask, and that's not necessarily healthy. It's great, and I'm happy to see sellers capitalize on that. That is their prerogative, but that doesn't necessarily mean it's a healthy balance for a market. But I just think that, short term, I think we'll settle in here somewhere in the threes. We maybe touch fours late this year, early next year, if at all. I think we really have to figure out what's going to happen around the pandemic, because technically we're still in the middle of that. Vaccines haven't hit critical mass yet. And I think we've all heard about all these other strains that could potentially be out there that maybe the vaccine doesn't have as big effect. So we're definitely not completely out of the woods. there's a whole lot of moving parts that goes into what rates will do. But if the market dictates that, hey, America's open, which I think it's starting to say that, then rates will continue to move up, right? And that's okay. That's okay. That won't be the end of the world.
And and on the real estate side of it, I would think, to slow down a little bit of this craze that we got going in here, raising the rates from the bottoms a little bit might not be a bad thing. I mean, it would definitely pull some buyers out of the pool, out of the buying pool. I realize that, but with home prices going, like you said, 30, 40, 70, $100,000 over asking and waiving appraisals and everything like that.
Yeah.
I think there needs to be a little bit of limitation on, or bringing that price up where that slows a little bit of the demand down, so we can kind of catch up and play catch up with the inventory we have left. I want to switch it a little bit to back to the second home and investment properties. On the investment side, what about someone looking for a multiplex, say like under 4 properties, they want to live in one of the units but rent out the other 3? Is that considered an investment, or is that considered a primary?
If you're living in there, it's a primary residence.
Okay, so if you're living in one of the units and you rent out the other 3, so that would still fall under the primary residential guidelines and the rates and all that. Okay,
correct.
Cool.
Correct.
I just wanted to kind of clarify that, because I know we have people listening in that are probably in that position, looking at multifamilies and wanting to do that like house hack where they buy one, stay in one, rent out the other 3. That doesn't really affect you. It's only going to affect if you want to make it a true investment property, correct?
Correct.
Okay.
Absolutely. And that's funny you say the house hack. I mean, that's such a hot topic these days.
Yeah.
Everybody's talking about it. But I was chatting with another guy that, I hate that I can't spit out the stat, but it was like if you start out by purchasing a 2-unit, you're 7%. I think it was 7% more likely to become a millionaire through real estate than if you just buy a primary residence.
Dang, really? Okay, cool.
And I was like, I wish I'd have wrote it down. It's one of those things. Obviously, we've connected in Clubhouse, and I've heard some stuff, and I've got to know the guy who happened to say that a little bit, and it's an interesting thing, right? Because here you are buying a multi-unit, right? And you're allowing someone else to share your expense on the debt, and taking all the great perks of appreciation in the marketplace. So it's definitely a good way to get started. Some people don't have the imagination for it. They're like, I don't want to have a shared wall. If I wanted a condo, I'd buy a condo.
Yeah.
But when you think big picture about getting in on that level and creating, what's the word nowadays? It's generational wealth. There's no better way than get started in real estate. 2 to 4 units are a great way to get started. And so,
we did an entire show. We did an entire show on house hacking and how to get started in and what to look for and why it's beneficial and all that stuff. So it's good to know that this is basically just a tie-in on that on the lending side, that you can still do that and it's not going to cost you a fortune anymore, or it's not going to cost you a fortune yet until other changes happen. But so that's really cool. Is there anything else that you want to talk about on the second homes and investment changes that happened? Is there any topics that you can think of that you think our listeners will benefit from?
I just think on the investment side, just pay attention to the numbers. Ultimately, it's not, it's a blip in the radar, in my opinion, right? Over time, if there's a good deal on the investment side, the people who do that are obviously investing, typically have the money and the wherewithal to understand whether or not it's the right deal or not. So, just crunch your numbers, be aware of the changes.
Yeah, and I think it's going to be, I think it's a bigger hit here for our second home buyers, more so than the investors, because investors are used to paying a higher rate. They're always used to, the investment portion used to be higher. The amount, the down payment requirements were higher. So another blip up is unfortunate, but it's not going to be as bad. I feel for like the second home buyers, especially in our market. Arizona is a very big area for second homes, for vacation homes, for the Airbnbs and all that fun stuff, which I know that falls under investment, but it's a big hub for second home buyers. What would you say to them? Like, how are you explaining it to your clients or clients that are calling you and asking you, hey, I heard about these changes. How does that affect me? Is that affecting their buying power? Is it, what are the changes in terms of
Yeah,
someone looking for a second home?
yeah. I mean, certainly, slightly higher rates will impact um, buying power. But at the end of the day, I would say if the numbers work, let's buy real estate, right?
Hmm.
Because you're going to get a good return in the long term, in the long run, right? So, yeah, it's one of those things where maybe there's some deals out there that aren't as juicy as they were previously. But again, if the numbers work and you're going to be a long-term investor in that property, it's still probably going to make sense from a long-term aspect. Um,
Cool.
I do think just something else to touch on because you brought up a good point is that investors are used to paying slightly higher rates for their deals. One thing I think this could catapult to is bringing in some additional private options into the market, stuff that's outside of Fannie and Freddie. Um, Private investors who say, okay, there might be some margin in there for us to come in and do, offer some solution to investors and second home purchasers and create some additional options. Post crash, it's all been really, really vanilla.
Yeah.
Most of the mortgages are great paper, high credit score, skin in the game with down payment, all that stuff. And so we're not at this big risk like we were in the crash with all these high risk, no doc, no income verification type loans. Almost everything that's on the books is very well vetted, right? So creeping those rates up some may create an opportunity for other entities and private entities to come into the marketplace and say, okay, let me see if there's a solution here that we can create. I really think for the overall greater good, that's something that we're definitely lacking. And so I'm hopeful that may happen that might be something that comes out of this change.
Gotcha. Well, that's awesome. Well, there you have it. That's the second home and investment home changes in financing and in rates. Thank you guys so much for joining us. Again, my name is Michael Fabro. I'm with the Ignite Group at West USA. I'm a realtor here in Scottsdale. Thank you so much, Tim, for spending some time with us today and educating us on the changes that are always happening in our industry, but especially this one here that I know we've been talking a little bit on Clubhouse and everything like that, and we've heard rumors. Sure. So it's nice to kind of expel those rumors and really get to really what the meat is of those changes. Again, not as bad as everyone sounds. It's that knee-jerk reaction, right? You hear something, it's like, oh my God, what happened? What is it? And then once we talk about it and explain it and go through it, it's really, it's just a change. It's going to take some getting used to, but it's not the end of the world by any means.
Absolutely. Absolutely. And listen, I really appreciate you having me on here. Thank you so much.
Awesome. Well, thanks again. We'll talk to you guys soon.
Take care.